Assalamualaikum. I am Muhammad Azhar bin Soemi from Group 2. Want to answer question 1. The question is discuss the subtitle China, Hong Kong, the business symbiosis. Do you agree with the metaphor and explain? The answer is yes, agree about the metaphor of China, Hong Kong. The business symbiosis in this study case, the statement can be proved by some of factors, which is first is China renewed Hong Kong in 1997 and respect of dynamism and entrepreneurial spirit. Second is another factor is China, Hong Kong already operate in a strong business symbiosis long before 1997. For the example, China was out of export quota for products such as textile and clothing. Hong Kong trade were always trained to re-export and China goods by using Hong Kong export quota entitlement. At the same time, the third factor is Hong Kong has been for many years the leading foreign direct investor in China. This is because contributing directly to China economic growth, the modernization. In recent years, many Hong Kong-based companies shift their manufacturing facility to China, and the tandem of the two economies has become the region top business hub. That's all from question 1 answer. Thank you.
Hi guys, I'm Jingting. I'm going to tell you guys the determinants of FDI of China compared to Hong Kong. In China, FDI has focused in labor-intensive industry during 1980s. From the point of view of foreign investor, having capital measured in foreign currency, all production inputs such as labor, land, machine, and asset in FDI hosting country become cheaper after the devaluation, encourage them to acquire more domestic assets. The labor force in China is relatively cheaper, especially compared to Western countries, and China has succeeded in exporting goods. Next, in the early of 1990s, technology-intensive investment became the main determinants of China FDI by upgrading its industrial structure. China has utilized foreign direct investment to introduce advanced technology from abroad in the initial stage of economic development after the economic reform. The Chinese government has attracted FDI by exchanging access to its huge market and its human resources for transfer of advanced technology from abroad. Next, the foreign investor also been attracted and aimed the size and potential 1.2 billion consumer market. Recently, the FDI in China are mainly on the R&D activity. Many transnational corporations with over 100 had chosen China as their R&D center in order to enjoy the tax benefit and use cheap R&D resources. At the same time, investors are aiming for the low cost but skilled labor force, technology and the market demand in China. Okay, for the Hong Kong part, unlike China, Hong Kong has had the highest degree of economic freedom in the world. Its economy is governed under positive non-interventionism and is highly dependent on the international trade and finance. The advantageous geographical location of Hong Kong make it become a great place to enjoy the world FDI, as Hong Kong is one of the world's leading international financial center with low taxation in service-oriented economy, which Hong Kong located in the proximity of China and other fast-growing ASEAN markets. Next, Hong Kong has the most efficient and a corruption-free application procedure, the lowest income tax, the lowest corporate tax, as well as an abundant and sustainable government finance. The government of Hong Kong consistently upheld the policy of encouraging and supporting activities of private businesses. In addition, sound infrastructure also one of the main determinants of Hong Kong FDI, which is OFTA. It is a legislation body responsible for regulating the telecommunication industry in Hong Kong. The OFTA has liberalized all telecom sector and has no foreign ownership restriction unlike mainland China.
My name is Gung Qian Hao. Today I want to discuss the third question in the case study. According to UTech, the number of the regional headquarters of a foreign firm in Hong Kong had dropped from the 1997 to 1998 and rise again in 2000. According to the UTech, the declining trend can explain by the two aspects which the reunification and economic crisis. The 1984 agreement between the Chinese and British government, the China assumed sovereign over the Hong Kong, but the China FDI has shown the slowdown trend for the 1995 to 2000 years, so seriously impact the Hong Kong economic performance in direct way, and cause dramatic slowdown in economic activity. Besides that, the ASEAN financial crisis of 1997 to 1998 negatively affected the Hong Kong economy. Government doesn't appear to attempt influence long-term structural evolution of Hong Kong economy. Furthermore, the number of regional headquarters of foreign firms in Hong Kong was rising again in 2000. They are having four main explanations for recent upsurge in FDI inflow to Hong Kong. First, the market growth in reinvested earnings reflect a recovery from the economic turmoil of 1997 to 1998 was related to the improved profit position of foreign affiliates in economy. Second, transnational corporation planning to invest in mainland China have been parking funds in Hong Kong in anticipation of business opportunity on the mainland. The third point is about the major cross-border merge and acquisition in telecommunication of Hong Kong acquired in the November 2000 years. The 7 mobile network on the mainland with a deal value of $33 million as an FDI outflow from the Hong Kong. The deal was partially financed by the $23 million in capital raised through the new share issue to its parent company in the British Virgin Islands and FDI inflow in Hong Kong. The last point, which is the increasing transit FDI into and out of Hong Kong, which the Hong Kong's investment inflow and outflow are related to the business venture as well as in the region, especially in the mainland. The issue is further complicated by the round-tripping phenomenon. In addition, the Hong Kong has traditionally enjoyed a favorable position in the world FDI with an advantage geographical location in the proximity of China and other fast-growing ASEAN markets, the sound infrastructure and low tax regime.
China. Hello, I'm Mahalakshmi. What you have in China is rosy macro and lousy micro. I'm going to discuss this statement. Yes, it is a true statement. China is the most suitable land for investments to be made in. However, it is lousy micro because to choose a specific sector to invest in China, it is not an easy thing. Now, let me share with you some reasons why China is the best place to invest in. China is the biggest internal market in the world with 1.3 billion potential customers. Next, China is a rapidly growing market, usually at least 7% growth per year. Even though the situation is changing in certain areas, labor costs remain comparatively low. With the development of the western provinces, particularly the Sichuan province, China offers new opportunities. As stated earlier, investors will have a hard time to choose which sector to invest on in China. However, the government of China has stated that it will encourage investment in certain sectors like technology, production of equipment or new materials, the service sector, recycling, clean production, the use of renewable energies and environmental protection. Besides, let me explain to you specifically why is it hard to choose a specific sector to invest in China. Investment in sectors that have already relatively strong production capacity and use advanced technologies will not be encouraged, says the Chinese government's foreign investment guide. The government too planned to restrict foreign investment in resource-intensive and highly polluting industries. Besides, the country too discourages foreign investment in sectors deemed key to social stability. Not just that, sectors which the country plans to develop domestic firms into globally competitive multinational corporations are also restricted from foreign investments. Foreign investors are also discouraged from investing in sectors that have historically benefited from state-sanctioned monopolies of a legacy of state investment. With all these restrictions, don't you think investors will have a hard time to choose which sector to invest in China?
And now, let's talk about the foreign direct investment and portfolio investment in China and Hong Kong, and figure out which one would be more volatile. A foreign direct investment, which is the FDI, involves establishing a direct business, substantial long-term interest in the economy of foreign country, while foreign portfolio investment, FPI, is investing in financial assets such as stocks or bonds, which stays money in the capital market only for a short period of time in a foreign country. Foreign direct investment inflows into China in 1997, which reached a record $45 billion, has been positively associated with the economic growth and the increase of the total fixed asset investment. FDI has also forced an increasing number of domestic manufacturers to compete globally. This has served China well to weather the financial crisis. FDI in China has been represented by the research and development activities which established by the transnational companies. Importantly, FDI has catalyzed China's economy reform in the long term, whereby foreign portfolio investment in China has also grown very much because it's a short-term investment and contains a very great amount of returns. With China experienced high growth in FDI, mainly towards some medium-term public debt instruments and the stock exchanges, while admittance to capital markets through the use of external instruments has been indicated. But there are also potential risks of a hinge of flow in the very short term. And now let's move on to the Hong Kong, the single largest FDI recipient in 1999 of an advantageous geographical location, a sound infrastructure, and a low tax regime. A government established Invest HK in July 2000 to take a responsibility for foreign direct investment and support overseas and mainland businesses to set up or expand in Hong Kong. It provides free advice and customized services to help businesses succeed in Hong Kong's vibrant economy. Foreign portfolio investment has become a very important factor contributing to Hong Kong's net creditor position, whereby debt market has been expanding. Leveraging on the comprehensive and effective financial facilities in Hong Kong, investors choose FPI for trading at relatively lower transaction costs and very sizable. Throughout the whole comparison between the foreign direct investment and foreign portfolio investment, FDI is certain, long-term and less fluctuating, while FPI is speculative, short-term and unpredictable. FDI is the real investment, whereas FPI is a monetary or financial investment in foreign country. Hence, FPI can be much more volatile than FDI. Thank you.
Hi, my name is Afiza binti Bagu. My matric number BG 1416078. Okay, now I will explain about my answer for my question number 6. Where would you prefer investing, in China or Hong Kong? In my opinion, I prefer investing in China than Hong Kong. One of the reasons because Far Eastern Economic Review indicates that China's stock markets have grown phenomenally in the course of the past decades to become the second largest in Asia after Japan. China's stock markets also the world best performing, so in order to get the best chance of earning a decent return, investors should advise to concentrate on company with a strong and growing consumer brand persist in China. Okay, my second point is JP Morgan said in Hong Kong, from the macroeconomic perspective, you should certainly invest in China. Besides that, there seems to a favor company likely to benefit from growing consumer demand within China. My third point, do you know, some experts predict that within 5 years, China could be the largest stock markets in the region with a capitalization surpassing even Japan. With a potential like that, China's stock markets is certainly to be sniffed. Now, I will explain to you why I don't prefer you to investing in Hong Kong. Firstly, Chinese company list on mainland exchange like Shanghai Core Asia. These are denominated in China's yuan Chinese. For Chinese investor, there is buy and sell, but the Chinese government allow some of this company to also list share on the Hong Kong exchange. Technically, such as the difficulty involved in cross-border trading between mainland and Hong Kong. For exchange, it plays a role. It's difficult for foreign investors to short stock on a mainland exchange. Hong Kong currency pegged to the US dollar, not the Chinese yuan. Also play a role in regulatory differences between the Hong Kong and Chinese markets also be a factor.